So we are studying chapter 12, which is the capital assets scheme under the UAE VAT law. Article 1 of the VAT law defines capital assets as business assets designated for long-term use. So under the capital assets scheme, the input tax initially recovered initially recovered is adjusted based on the actual use of a capital asset during a specific period. So, the provisions of the capital asset scheme are outlined in Article 60 of the VAT Decree Law and further explained by Article 57 to 58 in the VAT UAE VAT Executive Regulations. If a capital asset is supplied or imported by a taxable person, the taxable person shall assess the period of use of such an asset and make the necessary adjustments to the input tax paid pursuant to the capital asset scheme. So, what are the relevant assets? First of all, a capital asset for these purposes is a single item of expenditure of the business costing 85 million or more, excluding tax on which VAT is payable. So naturally, this is the base value on which VAT is applied, 5 million dirham, and having an estimated useful life of at least 10 years for buildings or a part thereof, or at least 5 years for all other capital assets. 10 years for buildings, 5 years for all other. That was Article 57 of the Executive Regulation, where costs for one item of expenditure are settled in staged payments, which is like consecutive invoices or periodic payments. In the below mentioned cases, the overall cost is considered as one sum for determining the 85 million or more limit, which is Article 57 of the Executive Regulation. Purchase, construction, extension, renewal, and other purposes of similar nature incurred in relation to a building, except that where there is a distinct breakdown, uh, any such works being undertaken, they would then be taken to be separate items of expenditure. Unless there is a distinct breakdown, then they will be considered as separate expenditure. Otherwise, they will be considered as part of the capital asset. Expenditure on the purchase, construction, assembly, or installation of any goods or immovable property. These are also part of the capital assets. Stock or inventory intended for resale is specifically excluded from the capital asset scheme. So all that, stock and trade or inventory that a company sells, inventory is something that we purchase with an intention to resell and make profit out of it. So that will never be considered as capital asset. So the operation of the scheme, how does the scheme operate? The initial recovery of input tax when a capital item is purchased is subject to the normal conditions for input tax recoverability rules discussed in a previous chapter. So we know normally like when we have input tax and it relates to taxable supplies, which are either zero rate or standard rate supplies, we recover that amount of input tax. And if it is something else like relates to residual pool, we apportion it. In the, in case of capital assets related input tax, initial recovery rules apply. So initial recovery of input tax when a capital asset is purchased is subject to the normal conditions for input tax recoverability. So in the VAT period of acquisition, input tax recovery is claimed subject to any input tax apportionment position. What we do is we claim the input tax recovery in the period of acquisition. A capital asset that is subject to the capital asset scheme shall be monitored, and the input tax incurred shall be adjusted as required over a period of either 10 consecutive years for buildings or part thereof, or 5 consecutive years for other capital assets, commencing on the day on which the owner first uses the capital asset for the purposes of its business. That was Executive Regulation number 58. For the purpose of the scheme, year one will always be the year in which the capital asset is acquired, and this recovery is calculated as normal. This effectively means we have to consider a further 9 adjustments for buildings and a further 4 adjustment for any other relevant capital assets. This is still Article 58 of the regulation. Note that the first VAT year or an internally developed capital asset shall be the year in which that asset is started to be used. So that note that the VAT year, the first VAT year of an internally developed capital asset shall be the year in which that asset is started to be used, basically put to use. So that is again Article 58. Capital asset adjustments. Let us talk about that. The initial recovery is based on the year one usage, which is which in illustration one was 50%. So uh, we have the illustration one coming for ahead. We'll read that. For the rest of the recovery period, where necessary, the taxable person must adjust each year as per the percentage of taxable use as calculated using the apportionment calculation. The formula for calculating the capital asset adjustment is as follows. We need to understand the formula. So total VAT on purchase divided by number of years. So that will give us the per year VAT, right? Into multiplied by initial percentage minus actual percentage. So that will be the capital asset uh, adjustment. So uh, if you really look at it, the initial percentage minus actual percentage, initial will be the year one calculation. We'll look at it. KX LLC acquires a mainframe computer for 80 to 40 million plus VAT of AED 12 million. So the total cost of the asset was 240 million and VAT was 12 million, and immediately starts using it. With an asset other than a building, a 5-year life is relevant for the capital asset scheme. Naturally, this is not a building, so 5 years will be applicable. In year one, the company calculates the taxable usage of the computer. In the first year, taxable usage of the computer is 50%. As per the input tax apportionment method adopted. So, because this capital asset is such huge that it affects both taxable and exempt supplies, so that is why apportionment happened, and we got to know that the 50% of the usage is related to taxable supplies, taxable usage. So, as per the input tax apportionment method. In year one, 86 million, which is 12 million into 50%. Why 12 million? Because the total asset, total, VAT was 12 million. So, 86 million total VAT into the usage, taxable usage, 50%. will be recovered subject to meeting all other conditions for input tax recoverability. Although 86 million is recovered in year one, this is effectively saying that the recovery on this capital asset is AED 1.2 million per year. That is AED 6 million divided by 5, which is like 1.2 million. Now, uh, in year two, the taxable use is again calculated at 50%. There is no adjustment required in year two. Why? Because you can see, I mean, if you look at the formula that we saw, it said total VAT divided by the number of years into initial percentage, which was 50% minus actual percentage, which is the second year. It is again 50%. So it will become 0% multiplied by something. So the adjustment is basically zero. This is capital asset adjustment. In year three, the taxable use is only 40%, which equates to 960,000, 40% of the AED 2.4 million. What 40% of the 2.4 million. The company had an upfront payment which effectively uh, gave them AED 1.2 million for each year, but in year three, they should not have had AED 1.2 million. They should have had AED 960,000. So what is happening here is that instead of 960,000, because their taxable usage was only 40% during the year three. So how much did they should they have claimed? They should have claimed only 960,000. But the usage pertaining to year three was 1.2 million, if you really think about it. Because what was the total VAT? The total VAT, if you remember, was 6 million. And here we had said if this is effectively saying that the recovery of the capital asset is 1.2 million per year. 6 million divided by 5, right? 6 million divided by 5. So every year the usage was 1.2 million. But in this year, year three, taxable usage was only 40%. So that the answer, so it's 960. So if it is 960, then what we have already claimed as recovery is 1.2 million, which is higher. So there is a capital asset adjustment of 240, which is for an excess recovery. So we have to reverse the benefit. So note the purpose of the capital asset scheme is to adjust for the input tax initially recovered. Basically, the whole idea is adjustment of input tax, which is initially recovered based on the usage over a number of years, which is 5 years for the computer in this example. Therefore, an adjustment would only be required if in subsequent years the usage changes from the initially recovered 50%. So, the whole idea is that every year, if the usage changes, then to the extent of that change, capital asset related input VAT will need to be adjusted. The recovery we already did in the first year. In the next years, we only pass an adjustment. The idea behind this is that it is effectively a recoupment as a result of the change in use. Apply the formula for capital asset adjustment in illustration 1 in year 3. AD 12 million, the total input tax originally charged is divided by 5. The life for a computer, 5 years, right? This is then multiplied by 50%, which is the initial year, minus 40%, which is the third year. So initial year will always stay the same, the first year. This gives KX LLC a capital asset adjustment of 240,000. We should let us see how we did that. how much was the total input VAT? It was 12 million divided by 5 years, and all we were doing is in the first year we just did 12 million divided by 5 years multiplied by 50. This next years we are taking an adjustment only. Initial year it was 50%. This year number three, the taxable usage has dropped. So if you how much is the drop? 10% drop. So that 10% of the amount that we already claimed, that was an excess recovery, which has to be paid back to FTA. This adjustment will be made in the first VAT period in its subsequent tax year. So first VAT period of the subsequent tax years. Subsequent tax year, which will mean that if this usage relates to year number three, it will the excess recovery will be adjusted in the first tax period of year four. Illustration 2. In the example above, illustration 1, for year 3, there will be an input tax adjustment. KX LLC would have to deduct 80 to 40,000 from input tax for that VAT period. This then forms part of the final payable tax due to the Federal Tax Authority for that particular VAT period. This is just an explanation, like this will be a reduction in the input VAT recovery for during pertaining to year 3, which will be reported to FTA in the first tax period of year 4. In the years when there is no change in taxable use as compared to year 1, no adjustment is needed. That will save a lot of time even in the exam side. If in the year 1 the taxable usage was 50% and in year 2 also 50%, no adjustment. It is a memory hook for you to remember. A record must be kept in a capital asset register showing the original input tax incurred and any adjustment, as well as how these have been calculated. That this record needs to be kept in capital asset register. Records relating to capital assets must be kept for a minimum of 10 years. Article 60 of the VAT Decree Law, not executive regulation, but decree law. Changes to the VAT here. So if a taxable person transfers its business as a going concern, as per Article 7 uh, of the VAT decree law, or joins or leaves a VAT group, uh, then the VAT year applying shall end on the day the taxable person transfers its business or joins or leaves a VAT group. So this is addressing of the change to the VAT year. A new VAT year is triggered starting the next day with the new owner. So that was change in ownership. Basically, sale of the business as a going concern, right? Sale of the business as a going concern. So the day that sale happens, that is the end of the tax year, and then the very next day, the new tax year triggers. Disposal adjustment, where a capital item is disposed of within the adjustment period, two adjustments shall be made: the normal adjustment and the sale slash final adjustment. So these what are these two adjustments? Sale adjustment and final. Normal adjustment and then the final adjustment. So normal adjustment is calculated in the usual way. Take the percentage for the taxable use of that VAT year and assume that the asset is used for the whole year for that taxable use. This adjustment is made in the first VAT period of the subsequent VAT year. We discussed it. uh, irrespective of the VAT period in which the sale was made during the year. So, irrespective of the year when the sale was made. So, I mean, we will disregard when the sales was made. The normal adjustment, which represents the change in use, that adjustment will be in the during the first tax period of the subsequent year, uh, of the year, which is subsequent to which we were calculating this normal adjustment. We've discussed all of that. But the new topic that we are looking at, the sale or final adjustment, follows the normal capital asset scheme method for the remaining complete years of the VAT life for that asset of the regulation. I- Uh, if the sale is a taxable sale, assume that the taxable use for the remaining years is 100%. So if we are selling the asset, and it is a taxable sale, which will be the majority of cases, then we have to assume that the remaining years will be 100%. The taxable use of for the remaining years will be 100%. So that means we can recover all of the input VAT. If the sale of the asset is exempt, assume 0% taxable use for each of the remaining year. Unlike the normal adjustment, this adjustment is made in the VAT period in which the asset is disposed of. Unlike the normal adjustment, this adjustment will be made in the VAT period in which the asset is actually disposed of. So that we need to remember. A similar treatment applies if the taxable person deregisters for VAT. So if we remember, deregistration is a situation of deemed supply, right? Whatever assets were there in the balance sheet, we treat them as if they are supplied, and we use their cost base and apply the VAT percentage on it, and report it and pay that VAT percentage to FTA. The similar treatment applies to taxable person deregistered for VAT while still owning the capital items. And within the adjustment period, on deregistration, in addition to the normal adjustment, the sale adjustment will serve to account for the deemed supply. So as I said earlier, the assets lying in your balance sheet, we will consider these assets as if they are supplied. So as if they are sold or as if they are supplied. So that's how it is. Illustration 3. Looking again at KX LLC from illustration 1, the mainframe computer is sold on the last day of year 4 for AD 15 million plus VAT. So the taxable use for the year 4 was 54%. For the normal year adjustment, assume the asset was used for 54% for the whole year. So the taxable use was 54%. Calculate the normal adjustment and sale adjustment. First of all, normal adjustment it should be easier for us to remember now. Total input VAT on that asset divided by the number of years, and then we had an adjustment quotient which is multiplied by initial usage, which was 50%, minus actual usage, which in this case is 54%. If you really look at it, there was 4% more usage compared to the initial usage. So that means we for this for the VAT benefit pertaining to this year, we under claimed actual usage. Actual taxable usage was 4% higher. That means we can now claim 96,000 dirhams in lieu of recovery. In the year of sale, there is also an additional sale adjustment. In the year of sale, there is also an additional sale adjustment. The computer was sold as a taxable supply plus VAT, thus 100% is the percentage of taxable use in the remaining years of the uh, adjustment. KX had the initial year of recovery and then another 3 years of normal adjustments. So that leaves 1 year to be accounted for in the sale adjustment calculation. So 12 million divided by 5 into 50% minus 100%. Now, actual use we are assuming as 100%, which will be which will indicate that we can claim, we can recover extra tax. And for how many years are we talking about? The life was 5 years for this asset. 4 years we have already claimed, so 1 year is remaining. So that is why I multiply by 1. So the remaining, taxable usage for 1 year, 100% actual usage minus the initial usage. So we can see that 1.2 million dirhams recovery we can claim. So this is how the final sale adjustment will be arrived at. Example 1, PCLC. So these are the examples that have to be solved by the candidate. We should do that, and the answers have also been provided. Thank you very much.